Section 1.1 to 2.2 Understanding short selling, profiting from downward market trends. 1.1 Definition and purpose. Short selling is a financial trading strategy in which an investor borrows a security, such as stocks, from a broker and sells it on the market with the expectation that its price will decrease in the future. The investor aims to profit from the price decline by buying back the security at a lower price and returning it to the broker. The process typically involves the following steps. The investor borrows the security from a broker, usually paying a fee or interest for the borrowing. The investor sells the borrowed security on the market, effectively taking a short position. If the price of the security declines as anticipated, the investor can buy it back at a lower price. The investor returns the borrowed security to the broker, typically closing the short position. Short selling is often used by traders or investors who believe that a particular security is overvalued or expected to decline in price. It allows them to profit from downward price movements in the market. However, short selling involves risks, as there is no limit to how much the price of a security can rise, potentially resulting in substantial losses for the short seller. Regulatory bodies and exchanges have specific rules and regulations in place to govern short selling to maintain market integrity. The purpose of short selling can be twofold: profiting from declining prices and implementing hedging strategies. Profiting from declining prices. The primary objective of short selling is to make a profit from the anticipated decline in the price of a security. By borrowing and selling a security that they do not own, short sellers aim to buy it back at a lower price in the future, thus profiting from the difference. This strategy is often employed when investors believe that a particular security is overvalued or when they expect negative developments that could impact its price negatively. Hedging strategies. Short selling can also serve as a hedging tool to manage risk in investment portfolios. Investors may use short selling to offset potential losses in their long positions. By taking a short position in a security that they expect to decline, investors can partially or fully offset the losses incurred from their long positions if the market turns unfavorable. Hedging with short selling helps investors protect their portfolios during market downturns or periods of volatility. It's important to note that while short selling can offer opportunities for profit and risk management, it also carries inherent risks. The potential losses in short selling are theoretically unlimited since there is no upper limit to how much a security's price can rise. Therefore, short selling requires careful analysis, risk management, and compliance with regulatory requirements. 1.2 How short selling works. The mechanics of short selling involve borrowing and selling shares of a security. Here is a step-by-step explanation of how it works. Identify the security. The investor identifies a security, such as stocks, that they believe will decline in price. They choose the specific security they want to short sell. Borrowing the shares. The investor needs to borrow the shares of the chosen security from a broker or another investor who holds the shares. This is typically done through a margin account. The investor requests to borrow a specific number of shares from the broker, selling the shares, once the shares are borrowed. The investor sells them in the market at the current market price. This step effectively establishes a short position. The investor receives the proceeds from the sale, which is credited to their account. Holding the short position, the investor now has a short position in the security. They have sold shares that they do not own, and they owe an equivalent number of shares to the lender/broker. Monitoring the market. The investor monitors the market closely to track the price movement of the security. The objective is to buy back the shares at a lower price to close the short position and return the borrowed shares. Buying back the shares, if the price of the security declines as expected. The investor decides to buy back the shares. They purchase the same number of shares they initially borrowed, but at a lower price, returning the borrowed shares. Once the investor buys back the shares, they return the borrowed shares to the lender/broker. This completes the short selling transaction. Calculating profit or loss. The profit or loss from the short selling transaction is determined by the difference between the initial selling price and the price at which the shares are bought back. If the shares were bought back at a lower price, the investor makes a profit. If the shares were bought back at a higher price, the investor incurs a loss. It's important to note that short selling involves risks, and the investor must carefully manage their position and be aware of the potential for losses. Additionally, regulations and margin requirements may apply to short selling, and it is crucial to adhere to them. Brokerages and margin accounts play a crucial role in facilitating short-selling transactions. Here's an overview of their roles. Borrowing shares. When an investor wants to engage in short selling, they typically need to borrow shares of the desired security. Brokerages act as intermediaries and provide access to a pool of shares that can be borrowed. They facilitate the borrowing process by arranging for the shares to be lent to the investor. This borrowing is done through a margin account. Margin accounts. Margin accounts are specialized accounts offered by brokerages that enable investors to borrow funds or securities for trading purposes. When short selling, investors need to have a margin account to borrow the shares they wish to sell short. These accounts require the investor to maintain a certain level of equity, or margin, in their account based on regulatory requirements and the broker's policies. Margin requirements. Brokerages set margin requirements, which are the minimum equity levels that investors must maintain in their margin accounts when engaging in short selling. Margin requirements help mitigate the risk for both the investor and the brokerage. The specific margin requirements vary based on factors such as the security being shorted, market conditions, and regulatory guidelines. Order execution. Brokerages execute the orders to sell the borrowed shares on behalf of the investor. They handle the technical aspects of the transaction, including matching the sell orders with buyers in the market. Account management. Brokerages manage the investor's account throughout the short selling process. They keep track of the borrowed shares, provide account statements, and handle the necessary administrative tasks related to the transaction. Interest and fees. When an investor borrows shares for short selling, they typically incur costs in the form of interest or borrowing fees. Brokerages charge these fees for facilitating the borrowing process and providing access to the shares. Regulatory compliance. Brokerages must comply with regulatory requirements and guidelines related to short selling. They ensure that investors adhere to the necessary regulations, including margin requirements and reporting obligations. It's important for investors engaging in short selling to understand the terms and conditions set by their brokerages, including margin requirements, interest rates, and associated fees. Working with a reputable and well-regulated brokerage is crucial to ensure a smooth and compliant short selling experience. Locating shares for borrowing is of paramount importance in the process of short selling. Here are the key reasons why locating shares is crucial. Facilitating the transaction. In order to engage in short selling, an investor needs to borrow shares of the desired security. Locating shares ensures that the investor can find and access the necessary shares to execute the short selling transaction. Without locating shares, the investor would not be able to proceed with the short selling strategy. Compliance with regulations. Short selling activities are subject to regulatory requirements and guidelines, which often include rules about locating shares for borrowing. Regulators may impose restrictions on short selling, such as uptick rules or circuit breakers, to maintain market stability and prevent abusive practices. By locating shares, investors can comply with these regulations and ensure that their short selling transactions are conducted in a legal and compliant manner. Availability and borrowing costs. Locating shares helps investors determine the availability of shares for borrowing. Not all securities may be readily available for borrowing, especially in illiquid markets or when there is high demand for short selling a particular security. Locating shares enables investors to assess the supply of shares and understand the potential borrowing costs, such as interest rates or borrowing fees charged by the brokerages. Managing short squeeze risks. Short squeeze is a situation where a heavily shorted security experiences a sudden and significant increase in price, leading to a rush of short sellers trying to cover their positions. Locating shares allows investors to gauge the potential risk of a short squeeze. If shares are difficult to locate or the borrowing costs are high, it could indicate limited supply and a higher likelihood of a short squeeze occurring. Execution of the strategy. Locating shares is a crucial step in the execution of a short selling strategy. Without locating shares, an investor cannot borrow and sell the securities, which are essential for implementing the short position. Locating shares ensures that the investor has the necessary resources to carry out the strategy as intended. In summary, locating shares for borrowing is essential for facilitating short selling transactions. Complying with regulations, assessing borrowing costs and risks, and effectively executing a short selling strategy. It provides the foundation for engaging in short selling and enables investors to participate in the market with a bearish outlook on a particular security. 2.1 Risk factors in short selling. Short selling carries the risk of unlimited potential losses and the possibility of margin calls. Here's an explanation of these risks. Unlimited potential losses. When an investor engages in short selling, the potential losses are theoretically unlimited. Unlike buying a security where the maximum loss is limited to the amount invested, short selling exposes the investor to the risk of the security's price rising indefinitely. If the price of the shorted security increases significantly, the investor will need to buy back the shares at a higher price, resulting in substantial losses. There is no upper limit on how high the price can go, which amplifies the potential losses in short selling. Margin calls. Margin accounts are used in short selling to facilitate borrowing and maintain collateral for the borrowed shares. The investor is required to maintain a certain level of equity, margin, in their account based on margin requirements set by the brokerage. If the price of the shorted security rises significantly, it can erode the investor's equity in the margin account. If the equity falls below the required threshold, the brokerage may issue a margin call. A margin call is a demand from the brokerage for the investor to deposit additional funds or securities to restore the required margin level. If the investor fails to meet the margin call, the brokerage may liquidate the short position, buying back the shares on behalf of the investor to cover the borrowed shares. This can lead to forced buybacks at unfavorable prices, exacerbating losses. Margin calls can create additional financial pressure on the investor, potentially leading to significant losses or the closure of the position if they cannot meet the margin requirements. It's important for investors engaging in short selling to closely monitor their margin accounts, manage their positions effectively, and have sufficient funds or collateral to meet margin calls if they arise. Due to the risks associated with unlimited potential losses and margin calls, short selling requires careful risk management, thorough analysis, and a clear understanding of the market dynamics. It is crucial for investors to have a well-defined strategy and the financial capacity to handle the potential losses and margin requirements involved in short selling. Market volatility and short squeezes are important factors to consider when engaging in short selling. Here's an explanation of how they relate to short selling. Market volatility. Market volatility refers to the degree of price fluctuation in the market. Higher volatility typically signifies larger and more frequent price movements. Market volatility can impact short selling in several ways. A. Increased risk. Higher market volatility can increase the risk of short selling. Sharp and unpredictable price swings can make it challenging to accurately predict the direction and timing of a security's price movement. It can lead to larger and faster price increases, potentially resulting in substantial losses for short sellers. B. Amplified profit or loss potential. Volatile markets can amplify both potential profits and losses in short selling. If the price of a shorted security moves in the desired direction, the potential profit can be magnified due to large price swings. Conversely, if the market moves against the short seller, the losses can be amplified as well. C. Liquidity concerns. Volatile markets may also lead to reduced liquidity, with fewer buyers or sellers in the market. This can make it more challenging for short sellers to execute trades and cover their positions when needed. Short squeezes. A short squeeze occurs when a heavily shorted security experiences a rapid and significant increase in price. It can be triggered by positive news, strong buying pressure, or a combination of factors. Short squeezes can have several implications for short sellers. Sudden losses. During a short squeeze, short sellers who are caught in a heavily shorted security may rush to cover their positions by buying back the shares. This surge in buying can further drive up the price of the security, resulting in sudden and substantial losses for short sellers. B. Forced buybacks. In a short squeeze, the increasing price and scarcity of shares available for borrowing may lead to margin calls for short sellers. Brokerages may demand additional collateral or even force the buyback of shares to cover the borrowed position. This can further contribute to the upward price pressure and increase losses for short sellers. C. Market disruptions. Short squeezes can create significant market disruptions, as the rapid price increases and forced buybacks can distort supply and demand dynamics. These disruptions may impact market participants beyond those directly involved in the short selling, potentially leading to increased volatility and uncertainty. short squeezes are a result of the interaction between supply and demand dynamics, investor sentiment, and market conditions. They highlight the importance of considering the risk of sudden and dramatic price movements when engaging in short selling. To mitigate the risks associated with market volatility and short squeezes, investors should conduct thorough research, manage their positions carefully, set appropriate stop-loss orders, and maintain sufficient risk management strategies. It is crucial to closely monitor market conditions, stay informed about potential catalysts or events that could trigger volatility, and be prepared to adjust or exit positions as necessary. Legal and regulatory considerations are vital when engaging in short selling. Here are some key aspects to be aware of. Regulatory framework. Different jurisdictions have specific regulations governing short selling. It is important to understand and comply with the legal requirements and restrictions applicable in the jurisdiction where the short selling activity takes place. These regulations aim to maintain market integrity, prevent market manipulation, and protect investors' interests. Disclosure requirements. Many regulatory bodies require investors to disclose their short positions or provide regular reports on their short selling activities. These disclosure requirements help regulators and market participants monitor short positions and identify potential risks or abusive practices. It is essential to comply with these reporting obligations and provide accurate and timely information as required by the regulatory authorities. Short sale price restrictions. Some jurisdictions impose restrictions on short selling by implementing price restrictions. For example, certain regulations may prohibit short selling below a certain price or limit short selling to an uptick or 0+ tick rule, which means short sales are only allowed if the last trade price is higher than the previous trade price. These restrictions are designed to prevent or mitigate potential market manipulation. Margin requirements. Regulatory bodies often impose margin requirements to ensure that investors have sufficient collateral or equity in their margin accounts when engaging in short selling. These margin requirements aim to manage risk and safeguard the stability of the financial system. It is crucial to understand and adhere to the margin requirements set by regulatory authorities and brokerage firms. Market abuse and manipulation. Short selling activities are subject to regulations related to market abuse and manipulation. Engaging in manipulative practices, such as spreading false information or engaging in coordinated trading to artificially lower a security's price, is strictly prohibited. Investors must refrain from any activity that could distort market prices, mislead investors, or undermine the integrity of the market. Exchange and brokerage rules, in addition to regulatory requirements. Exchanges and brokerage firms may have their own specific rules and policies regarding short selling. These rules can include trading restrictions, margin requirements, and reporting obligations. It is crucial to understand and comply with the rules set by the specific exchange and brokerage where the short selling activity is conducted. International considerations. If engaging in cross-border short selling, it is essential to consider the legal and regulatory requirements of multiple jurisdictions involved. Different countries may have varying regulations and reporting obligations that need to be addressed to ensure compliance. It is recommended to consult with legal and financial professionals, as well as regulatory authorities, to fully understand and comply with the legal and regulatory considerations related to short selling. This will help ensure that the short selling activities are conducted within the boundaries of the law and regulatory framework, promoting market integrity and investor confidence. 2.2 Risk management in short selling. Setting stop-loss orders is an important risk management tool used by investors, including those engaged in short selling. A stop-loss order is an instruction to sell a security when it reaches a specific predetermined price, known as the stop price. Here are some key considerations when setting stop-loss orders. Determining the stop price. The stop price is the price at which the stop-loss order is triggered, and the security is automatically sold. The stop price should be chosen based on careful analysis and consideration of factors such as the investor's risk tolerance, market conditions, and the specific security being traded. It is typically set below the current market price for a short position to limit potential losses. Adjusting stop prices. Stop-loss orders should be periodically reviewed and adjusted as market conditions change. Investors may choose to tighten or widen the stop price based on factors such as volatility, upcoming news events, or changes in the investor's risk profile. Regular monitoring and adjustment of stop-loss orders help ensure they remain effective in managing risk. Balancing risk and avoiding premature exits. Setting stop prices too close to the current market price may result in premature exits from a position due to normal price fluctuations. This can lead to missed opportunities if the security continues to decline. Conversely, setting stop prices too wide may expose the investor to larger potential losses. It's important to strike a balance between risk management and allowing for normal market movements, technical analysis, and support levels. Traders may use technical analysis tools, such as chart patterns or support levels, to help determine appropriate stop prices. Support levels are price levels at which buying pressure has historically prevented a security's price from falling further. Setting a stop price just below a significant support level can be a strategy to limit losses and potentially capture a reversal in price. Mental stops versus hard stops. Investors can choose between mental stops and hard stops. A mental stop refers to a mental note or subjective decision to sell a position if a specific price level is reached. A hard stop, on the other hand, is a preset order placed with the brokerage that triggers the sale automatically when the stop price is reached. Hard stops are generally recommended as they remove emotional bias and ensure execution of the stop-loss order even if the investor is not actively monitoring the position. Market conditions and liquidity. It's important to consider market conditions and liquidity when setting stop-loss orders. In highly volatile or illiquid markets, stop-loss orders may not be executed at the exact stop price, potentially resulting in a higher or lower sale price. It's advisable to assess the liquidity of the security and the market conditions to ensure that stop-loss orders can be executed effectively. Setting stop-loss orders is a risk management technique that helps protect against potential losses and assists in disciplined trading. However, it is important to note that stop-loss orders do not guarantee execution at the specified price, particularly in fast-moving or volatile markets. It's recommended to regularly review and adjust stop-loss orders based on market conditions and individual risk preferences. Position sizing and capital allocation are crucial elements of risk management and portfolio management. They involve determining the appropriate amount of capital to allocate to each trade or investment position. Here are some key considerations. Risk tolerance. Position sizing and capital allocation should align with an investor's risk tolerance. Risk tolerance refers to the investor's ability and willingness to withstand potential losses. It is important to assess individual risk tolerance before determining the size of positions and allocating capital. Higher risk tolerance may allow for larger positions, while lower risk tolerance may require smaller positions to limit potential losses. Risk-reward ratio. The risk-reward ratio is a key factor in position sizing. It is the ratio of potential profit to potential loss for a given trade or investment. A higher risk-reward ratio generally indicates a more favorable trade setup. By considering the risk-reward ratio, investors can determine the appropriate position size that aligns with their risk management goals and desired potential return. Portfolio diversification. Capital allocation should take into account the overall diversification of the investment portfolio. Diversification involves spreading capital across different asset classes, sectors, or securities to reduce concentration risk. Allocating capital across a diversified portfolio can help mitigate the impact of any single trade or investment position and potentially improve risk-adjusted returns. Position size limits. Setting position size limits is important to prevent overexposure to any single trade or investment. It is generally recommended to avoid allocating a significant portion of capital to a single position, as it can increase the impact of potential losses. Position size limits may be set as a percentage of the total portfolio value or based on predefined risk thresholds. Account size and leverage. The size of the trading or investment account influences position sizing and capital allocation. Larger accounts may allow for larger positions, while smaller accounts may require more conservative position sizes to manage risk effectively. Additionally, the use of leverage, if available, can significantly impact position sizing and risk. It is important to understand the risks associated with leverage and consider its impact on position sizes and capital allocation. Risk management techniques. Position sizing and capital allocation should be integrated with risk management techniques such as stop-loss orders and risk limits. These tools help define the maximum acceptable loss for a trade or position, allowing for better risk control and capital preservation. Consideration of risk management techniques can help determine appropriate position sizes and capital allocation. Ongoing monitoring and adjustments. Position sizing and capital allocation should be reviewed and adjusted as market conditions, portfolio performance, and risk tolerance change over time. Regular monitoring of positions and the portfolio helps ensure that the allocation of capital remains aligned with investment objectives and risk management goals. It's important to note that position sizing and capital allocation are subjective decisions that depend on individual risk preferences, investment strategies, and market conditions. It is advisable to seek professional advice or consult with a financial advisor to determine the most appropriate position sizes and capital allocation strategies based on individual circumstances and investment goals. Diversification is a fundamental concept in portfolio management that involves spreading investments across different asset classes, sectors, and securities to reduce risk and potentially enhance returns. Here are some key aspects of diversification and its role in portfolio management. Risk reduction. Diversification helps to mitigate the impact of any individual investment's performance on the overall portfolio. By allocating capital to a mix of different investments, the risk associated with any single investment is reduced. Diversification can help smooth out portfolio volatility and reduce the potential for significant losses resulting from the poor performance of a single investment. Asset class diversification. Allocating capital to different asset classes, such as stocks, bonds, cash, real estate, and commodities, can help balance risk and return. Different asset classes have varying levels of risk and tend to perform differently under different market conditions. By diversifying across asset classes, investors can potentially capture returns from different sources and reduce the impact of any one asset class's poor performance on the portfolio. Sector and industry diversification. Within each asset class, diversification can be achieved by investing in various sectors and industries. Different sectors and industries have unique risk exposures and performance drivers. Spreading investments across sectors helps reduce concentration risk and the impact of adverse events specific to a particular sector or industry. Security selection diversification. Diversification can also be achieved by selecting a variety of individual securities within each sector or asset class. Investing in a mix of stocks, bonds, or other securities with different characteristics, such as size, geographic location, or company type, can further reduce risk. This diversification helps to capture the potential upside of different securities while reducing exposure to any single security's downside risk, portfolio performance, and return potential. Diversification is not intended to eliminate all risk but rather to manage and balance risk. A well-diversified portfolio aims to achieve a more stable and consistent performance over time. While diversification may not eliminate the possibility of losses, it can enhance the potential for positive returns by participating in different market opportunities. Rebalancing. Diversification requires periodic monitoring and rebalancing of the portfolio. As investments fluctuate in value, the original asset allocation may deviate. Rebalancing involves adjusting the portfolio back to its target allocation by buying or selling assets. Regular rebalancing ensures that the portfolio remains aligned with the intended diversification strategy and risk tolerance, individual risk tolerance and objectives. The level of diversification in a portfolio depends on the investor's risk tolerance and investment objectives. Some investors may prefer a higher level of diversification to reduce risk, while others may be comfortable with a more concentrated portfolio. It is essential to consider personal risk preferences, time horizon, and investment goals when determining the appropriate level of diversification. It's important to note that diversification does not guarantee profits or protect against losses in all market conditions. Market risks and other factors can still affect portfolio performance. Therefore, diversification should be complemented with thorough research, risk management techniques, and ongoing monitoring of investments. Consulting with a financial advisor or investment professional can help tailor diversification strategies to individual needs and provide guidance on portfolio management techniques based on specific goals and circumstances.